Welcome back. Today, we're breaking down the timeless investing wisdom of Warren Buffett, the Oracle of Omaha. He turned a modest investment into the multi-billion-dollar Berkshire Hathaway empire, not with secret tricks, but with simple, powerful principles. Buffett's approach proves you don't need to be a Wall Street genius to succeed. You just need common sense, patience, and a focus on business fundamentals. I've distilled his philosophy into 6 core stock market tips that anyone can use, whether you're just starting or already investing. These aren't just sound bites. They're the pillars behind decades of Buffett's success. Ready to change how you think about money? Let's dive in. And if you find this valuable, hit that like button. Buffett's first and most important principle is simple yet profound. Invest for the long term. This approach is the foundation of his entire investment philosophy, and it's what sets him apart from the crowd. Forget chasing hot stocks or trying to predict the next big market move. Buffett's favorite holding period is forever. He's not interested in quick wins or short-term trends. Instead, he focuses on the power of compounding over many years. Buffett buys businesses, not just stocks. He looks for companies with strong fundamentals, talented management, and a clear path to long-term success. His goal is to own companies he believes will thrive for decades, not just for the next quarter. Think of it like buying a coffee shop in your neighborhood. You wouldn't buy it hoping to sell it next week for a quick profit. Instead, you'd nurture it, build relationships with customers, and watch it grow over the years. This long-term mindset frees you from the stress of daily market swings and the anxiety of trying to time your trades perfectly. You stop worrying about every headline and start focusing on what really matters. Instead, you concentrate on the quality and durability of the business itself. Ask, does this company have a lasting advantage? Is it built to survive tough times and prosper in the future? Buffett's legendary investments, like Coca-Cola and American Express, were held through recessions, crashes, and market panics. He didn't sell when things got tough because he believed in their long-term value and resilience. The goal isn't to guess next month's price, but to own wonderful companies and let them grow. Like planting a tree, the real rewards come with patience and time. Real wealth comes from time in the market, not timing the market. The longer you stay invested, the more your money can compound and multiply. Always ask yourself, would I be comfortable owning this business for the next 10 years, through ups and downs? If the answer is no, it's probably not the right investment for you. This shift in perspective saves you from costly mistakes like panic selling or chasing fads, and puts you firmly on Buffett's path to lasting success. It's simple, but not easy. It takes real discipline to ignore the noise, stay patient, and trust in your process when everyone else is panicking or chasing the latest trend. But if you can master this mindset, you're already ahead of most investors. You'll be able to weather storms and celebrate the rewards of long-term growth. Remember, think like an owner, not a gambler. Investing isn't about luck or quick bets. It's about building something valuable over time. Invest for the long haul, set your sights on the future, and let your investments work for you year after year. That's how Buffett built his fortune, and it's how you can build yours too. Buffett's second rule, never invest in a business you can't understand. This is your circle of competence. Stick to what you know. You don't need to be an expert, but you should be able to explain how a company makes money and why it will succeed. Buffett avoided tech stocks during the dot-com bubble because he didn't understand them, and he avoided disaster. Your circle of competence is unique to you. Maybe it's healthcare, gaming, or retail. Be honest about what you know and, more importantly, what you don't. The biggest mistakes come from overconfidence, not ignorance. Before investing, research, read annual reports, understand products, competitors, and what makes the company special. If you can't explain it simply, it's outside your circle. There's no shame in passing on what you don't understand. Stick to businesses you truly get, and you'll have the conviction to hold through tough times. That's how you build real confidence and avoid panic selling. Know your circle and stay within it. That's Buffett's edge. Buffett's third tip, don't follow the crowd. In investing, it's easy to get swept up in the excitement or panic of the masses, but true success often comes from going against the grain. He's the ultimate contrarian. Be fearful when others are greedy, and greedy when others are fearful. This philosophy has guided him through decades of market ups and downs, helping him spot opportunities others miss. Markets are driven by emotion. Fear and greed can cloud judgment, leading to irrational decisions and wild price swings. When everyone's euphoric, risk is highest. It's tempting to join the celebration, but that's often when prices are most inflated and danger lurks just beneath the surface. When panic hits, opportunity knocks. The best bargains appear when fear dominates and most investors are running for the exits. In 2008, while most fled the market, Buffett invested billions in strong companies others abandoned. He saw value where others saw only risk and chaos. He wasn't guessing. He trusted his research and long-term view. Buffett's decisions were based on careful analysis, not on the latest headlines or market rumors. To succeed, you must think independently. Independent thinking means questioning the consensus and being willing to stand apart from the crowd, even when it feels uncomfortable. Don't let headlines or social media dictate your moves. The noise of the news cycle can be overwhelming, but it rarely tells the whole story. Do your own research, form your own conclusions, and have the courage to act, even if it means standing alone. The best investors are those who trust their process and stick to their convictions. The crowd is often wrong at the extremes. When everyone is convinced the market can only go up or down, that's when surprises happen. Watch for signs of greed. When everyone's bragging about gains, be cautious. Widespread optimism can signal that a bubble is forming. When fear dominates, start looking for bargains. The best opportunities often appear when others are too scared to act. It's not about being different for the sake of it, but about recognizing when the market's emotions create opportunity. Contrarian investing is about patience, discipline, and seeing beyond the moment. Train yourself to buy when others are scared and to be cautious when others are euphoric. This mindset takes practice, but it's essential for long-term success. This discipline unlocks extraordinary returns. Over time, those who resist the crowd's emotions are rewarded with outsized gains. Separate market mood from business reality. Buy fear, sell greed. That's the contrarian edge. It's a simple rule, but not an easy one to follow. It's tough, but it's where the biggest gains are made. Don't follow the herd. Dare to think differently, and you'll find opportunities others overlook. Buffett's fourth rule is simple, but powerful. Focus on value, not price. This principle is at the heart of his investment philosophy and has guided his decisions for decades. Price is what you pay, value is what you get. The price of a stock is just a number on a screen, but the value is what truly matters in the long run. The market price can swing wildly from day to day, but value is rooted in the fundamentals, things like earnings, cash flow, and the company's potential for growth over time. Buffett seeks out companies whose intrinsic value is much higher than their current price, essentially buying $1 for 50 cents. This is how he finds opportunities others might overlook. This margin of safety is crucial. It acts as a buffer, protecting you from errors in judgment, unexpected events, or sudden market swings that can catch investors off guard. Don't be tempted by stocks that look cheap on the surface. Instead, focus on finding great businesses at reasonable or even slightly discounted prices. A mediocre company, even if it's trading at a bargain, is unlikely to deliver strong returns. Cheap doesn't always mean good. On the other hand, a wonderful company, even if you pay a fair price, can compound in value for years, rewarding patient investors with steady growth. Think like a business analyst, not a chart watcher. Study the company's financials, management, and long-term prospects, rather than just following price trends. Estimate a company's true value, compare it to the current market price, and only invest when there's a clear and meaningful gap between the two. If the price is too high, don't rush in. Wait patiently for the right opportunity. Sometimes the best move is to do nothing until the odds are in your favor. This disciplined approach takes effort and patience, but it's what separates true investors from mere gamblers who rely on luck and speculation. Anchor your decisions in business reality, not in the noise or hype of the market. Let the numbers and facts guide you, not emotions or headlines. Always protect your downside and look for ways to maximize your upside. This is how you build wealth steadily and avoid costly mistakes. Remember, price is what you pay, value is what you get. That's the Buffett way, and it's the key to long-term investment success. Buffett's fifth principle: be patient and disciplined. The market rewards those who wait, not those who act constantly. Patience means waiting for the right opportunity, sometimes for months or years. Buffett compares it to waiting for the perfect pitch in baseball. There are no called strikes in investing. Be selective. Only swing at the no-brainers. Once you invest, give your companies time to grow and compound. Don't sell just because of short-term price moves. If your original thesis holds, ignore the noise. Discipline is what keeps you on track. Sticking to your rules, resisting emotional decisions, and staying within your circle of competence. Create a system based on these principles and follow it, especially when it's hardest. Like a diet, the plan is simple. The challenge is sticking to it. Remove emotion, act rationally, and let compounding work. Don't churn your portfolio. Be a patient owner. The ability to sit still and do nothing is a superpower in investing. Cultivate patience, build discipline, and your future self will thank you. That's how Buffett wins. Be patient, be disciplined. The final tip, reinvest your profits. This is the secret to compounding. Your returns generate more returns, snowballing over time. Buffett's wealth exploded after age 50, thanks to decades of letting investments compound. Don't cash out after a small gain. Keep your money working for you. Reinvest dividends and profits to buy more shares or assets. Set up automatic dividend reinvestment plans, DRIPs, to keep the compounding engine running. The longer you let your money compound, the more dramatic the results. Even small, regular investments can grow into fortunes over decades. The key is consistency and patience. Don't interrupt the process. Every profit or dividend is a chance to reinvest and grow your wealth. Build an army of dollar bills that work for you, and their children do too. This is how you turn a good strategy into a life-changing one. Combine great companies, fair prices, and relentless reinvestment. That's the Buffett blueprint. There you have it, the 6 pillars of Warren Buffett's success. Invest for the long term, understand what you buy, don't follow the crowd, focus on value, be patient and disciplined, and reinvest your profits. These principles aren't complicated, but they require a mindset shift from get-rich-quick thinking. Anyone can apply them. No PhD required, just business sense, patience, and discipline. Which tip resonates with you most? Let me know in the comments. If you found this helpful, hit like and subscribe for more investing wisdom. Thanks for watching, and I'll see you in the next one. Stay smart and invest like Buffett.